All right, thank you. So today, again, is October 22nd, 2021 for just recording purposes. And I want to jump right in here as we're been starting off ever since the pandemic with the kind of COVID numbers. And it's important to know where the COVID numbers are because it drives so many factors. It drives economic factors, inflation factors, and I'm going to get in all that today. But there's some pretty encouraging news on that front. As you can see here, we're looking at North America. So obviously this is Canada, US, and Mexico. And on the left side, we're looking at cases, and on the right side, we're looking at deaths. So you can see that there was the biggest wave occurred in kind of January, end of the year. And then it went down, and then we had the Delta variant come back in. And now, as you can see, we've been declining significantly. Along this time frame, we've also been, obviously, a couple things. We've been getting, the different vaccines that have come out, and people have been getting vaccinated. At the same time, you also have kind of natural immunity from people getting that, and I'll show a slide on that in a bit. But the encouraging thing here is that you can see the deaths are significantly down. Deaths are lagging cases, obviously, and cases are really starting to come down quite a bit. We're from Florida, and in Florida, we're at almost all-time lows right now. So had a really bad spike a few months ago, come back down significantly. So that's encouraging because that helps people get back to work. People have more confidence in working and getting back to the office and traveling more and going out to eat more, and all these things drive the economy. So this is South America, and in one of our last updates, we had talked about how bad some of the emerging market countries like Brazil and like in India that got hit really hard because the vaccines took a little bit longer to get down to some of the emerging market countries. So they are getting vaccinated at a very fast rate. Plus, there's been a level of herd immunity from just a number of people getting being exposed to it. And you can see here now cases are really pretty much at the lows of the pandemic, other than when it first started last year, and the same thing with deaths in South America. So that's super encouraging. It looked really bad for a period of time at the kind of early, springtime of this year, but looking much better now. And then, as you can see here, this is Asia, big country here being India, and similar to like South America and Brazil, got hit really hard in kind of the March, April, May months, but have now come down significantly, both in cases and in deaths. So that's very encouraging. And then if we look here, this is the European Union. It definitely a trend lower over time. And a lot of these countries, especially some of the countries like Germany and United Kingdom and France and Spain, have really high vaccination rates. And even though they have been spiking up a little bit as the economy opens up and people start going to restaurants and going back to schools and going back to different stadiums, sporting events, things like that, cases have risen a little bit here recently, but deaths have stayed very low and nothing near what the prior waves were. And instead of it being big sharp spikes, you can see it more of a slow rise. Which is encouraging. So this is a good slide. I really want to focus more on the right part of the slide here, which shows, immunity is formed in two ways, right? You have people who are vaccinated and then people who have already been infected. And in both cases, you have the antibodies, which makes you less susceptible to severe cases and symptoms. And reduce your probability of dying from coronavirus. And so you can see in this chart, right now, if you combine the people who are vaccinated, which are in green, obviously estimated of who's been infected and vaccinated, and then in blue is infected only. And if you combine all that together, we're up towards 85%. So we're right at that point where you're pretty much at herd immunity, which is super encouraging. And those numbers are similar across the world, different in terms of how many people are vaccinated versus how many people are infected, but the overall number is pretty similar across the world. So that's super encouraging. What will most likely happen, and obviously I don't know the future, but the coronavirus will become less severe over time. obviously it can mutate and things can happen. I don't claim to be an expert in that area, but as people become more have had it or had the vaccine, then the cases are less severe. So over time, I think what you'll see is the population will learn to live with it, and the economy will start to return more and more back to normal. So all of that to say, very encouraging news on the front of coronavirus and this pandemic.
So Jason, before you go on, that's what we've been living the last couple of years. So this has been a reality, global reality. So I want to do a quick pause before you start getting into actual numbers today, because that was a retro look at and bringing us today with the pandemic. But we want to engage our audience here for a second on a light way, in a light tone, and then in a more serious tone. So this is a chance for you to participate with a poll question, and we're going to shoot this out there. Again, feel free to answer. I think you can answer right on your computing device there, but I'll ask our poll person to put up the first question. Here it is: cable versus streaming icebreaker. Do you still have cable, or have you cut the cord? Haha, that was our person who made the poll question, being lighthearted, but choices are: I love my remote and the thousands of channels I get on cable. I'm a streamer all the way: Netflix, Hulu, YouTube, Amazon, anything but cable. Or I'm about half and half. I have cable still, but I also have Netflix, etc., or some other streaming service, not to discount Disney Plus or anything of that nature. So let's just give our audience a second here to answer a question. Which one are you? All cable, all streaming, or half and half? And this comes into play with so many different things that we've seen, as far as even investing and different companies and how they're doing as far as cornering markets and media. But whenever you're ready, let's take a look at what the answers are here. Okay, so we have no one loves the remote and the thousands of channels. We either have all the way streamers or some half and half. But most are streamers. 75% of people are streaming content right now. Very good, very good. So now a little bit more on a serious note. Not that that's not serious. If we can have one more question to get you guys engaged and participating. Go ahead, put the question up when you can, Mr. Poster. Okay, retirement. What about retirement means the most to you? One choice, please. The freedom to do what I want, when I want. And again, what does retirement mean to you the most? So the freedom to do what you want when you want, resources to make meaningful impact on the people, communities, and issues I care about, the ability to invest time and resources with those I love, or secure from financial worry about running out of money or being a burden. So all very valid reasons. No one is right or wrong, just which one would mean the most to you if you had to pick one as far as retirement. So we'll give you a second to answer that question. All right, let's see what people answered here. Okay, this one's spread out a little bit more. Some people want the freedom to do when you want it, resources to make impact. So we're almost, the two are in the middle. Ability to invest time and resources with those you love are right neck and neck. And then secure from financial worry seems to be the #1 reason. Very good. So thank you and we take this into account. We do financial planning, and obviously we do portfolio management. So we thank you for sharing, and just good food for thought. So Jason, go ahead. Tell us what's going on right now.
Yeah, absolutely. So it's a good little commercial break there. So transitioning from the coronavirus cases, deaths reducing, the pandemic improving, people getting back to work. This is putting the numbers behind kind of people getting back to work. And so we have 4 different charts here, and the red line in each chart represents where we were prior to the pandemic. And then the purple line is where we are currently. So the top left one, which is the unemployment rate, you can see it's down to 4.8%. Actually, at our lowest point prior to the pandemic, we were down by about 3.5%. But on average, we were pretty close to 5 a year leading up to, pretty close to 4 a year leading up to the pandemic. So that's encouraging. And then continuous claims, meaning people continuing to claim unemployment, that has significantly come down, which is an encouraging sign. And part of this too is, the federal unemployment that was extended through the pandemic ended in September. So now people are kind of if you will, being forced to go back to work. They can no longer depend on unemployment insurance. And so now you should see, or we already have seen, unemployment numbers really start to improve and kind of get closer to normal. And then, what the one that still needs some time, and this is usually the slowest one, even coming off of the financial crisis, and just in general coming out of any major recessions, is the long-term unemployment. So people unemployed more than 27 weeks. And you can still see, while we've made progress recently, and you can see a pretty sharp drop in the last month or so, still have a ways to go. We were down around 1.2 million prior to the pandemic, and now at 2.7 million. So we still have quite a few long-term unemployed, but a lot of these other metrics, including people who are claiming like new initial claims for unemployment insurance, we're back down to 290,000 of this past week, which is pretty close to where we were pre-pandemic. So in the US, unemployment's really started to improve. It can improve further, but it's come a long way. So that's encouraging. And that's not only encouraging from the economic standpoint, but it's also encouraging from an inflation standpoint. Now, I'll get to that here in a second. So this, US is the #1 economy in the world size-wise. China's #2. So it's important to look at where China stands in a lot of these areas as well. But you can see here the red line representing pre-pandemic for the unemployment rate for China. And China's now actually lower unemployment than prior to the pandemic. So that is good for the global economy. Now, as I was mentioning, the inflation rate and how these numbers affect inflation. So, really quick, simple economic class, inflation is really determined a lot by supply and demand. And, in early part of the pandemic and even all the way through early 2021, there was a huge influx of cash, a lot of stimulus that went directly to the population and businesses in the form of PPP here in the US. At the same time that you get that influx of cash, you also had a reduction in supply, but the supply being the amount of people who are producing goods and materials. So unemployment went up a lot of furloughs, a lot of unemployment, and so therefore there wasn't as many things being produced or manufactured, and so you had a combination of a really high a really high demand and the influx of cash, and a reduced supply of materials and products to buy from. And in that case, when you have increased demand and a decreased supply, that increases prices, and that causes inflation. And so, inflation this year went from around 1.3% at the beginning of the year, as high as about 5.4%, which is where we stand right now. Now, the inflation rate started to roll over, and you can see definitely it's not accelerating anymore, but now it's kind of staying at this higher level. And what we believe is going to happen is this is going to come back down over time. It started to do it, and then the Delta variant really kind of paused, a lot of the people going back to work for a period of time, especially around the world. But now, as you can see in those numbers I showed you at the beginning of this presentation, it's starting to, unemployment is reducing. People are going back to work. There's going to be more goods manufactured. People are working at the ports. Things like that are causing these kind of supply chain disruptions are starting to improve. And so what we believe is going to happen is that you're going to start to see this slowly come down over time. And while it may not get back to that 1.2%, we think it'll get back here kind of closer to the 2.5%, 3% over time. So we do believe you could potentially have a higher inflation rate over time, but we don't believe we're going to stay up here at this 5% for a long period of time. So that could help on a number of fronts. At the same time, what can also battle inflation is just higher prices in general. So if prices are super high, like it's very expensive right now to buy a car, it's very expensive to buy a house, you may not buy a car or a house right now. Maybe you wait. And so that would reduce the amount of demand there. So, this is something that we think it's been on a lot of people's investors' mind. It's something that we think that will start to improve over time. However, we believe it will be elevated from where it was prior to the pandemic for an extended period of time. So you have inflation. This is kind of skipping gears here over, or changing gears, if you will, over to, and I want to show you kind of, this is going to be a little bit of a complicated chart here, but this is looking at valuations, and it's specifically focused on US stock valuations. And the yellow line really represents kind of the long-term valuations and kind of the average returns over the next 1 year when valuations are this high. And so on the bottom axis here, this is your your PE, so price to earnings. So that is the further you go to the right, the more expensive you get, and then the further you go to the left, obviously, the cheaper you get. And then this is returns of the S&P 500 during that time frame. So in general, when stocks are cheaper, this line is higher, producing higher returns on average. When valuations get more expensive, your returns tend to go down over time. Now, each one of these dots represents, what the returns that have happened, the different, with valuations where they're at right now, it's the different returns that have happened during that time when PE ratios are at this level right here. So you can see in this chart, it's very busy, but you've had some times where markets had really difficult, 15, 20, 25% losses. But you've also had times where you've had the markets return 40 and 20%. So, and what's interesting here is you didn't have really anything in the middle. So I point out to say it's very difficult to kind of predict over the next 1 year, especially when you're looking at from a valuation perspective. But if we go over here on the right side, this is looking at the next 5 years and the returns for US stocks in particular during this time frame. And what's really interesting is this chart right here, as you can see, where the valuations are, over the next 5 years, valuations would be, typically lower on average, and that's a lot more consistent dots here than you would be if valuations were really cheap over here. And you can see the returns are typically much higher during that time. This is a reason why we tend to be value money managers and look for value. Value in stocks, and if you can find stocks that are at a good value and different investments in general are at a good value, over time, those typically have higher returns. But as you can see in this chart, dots are everywhere. You don't necessarily know the future, but you're trying to understand the probabilities behind where our current conditions are and where we'll be going in the future. And so I don't point this chart out to say, hey, we're going to have very low returns in your portfolios over the next 5 years. Get prepared for that. We're not saying that necessarily. What we're saying here is US stocks in general are pretty highly valued and potentially could have lower returns than they have historically. So that being said, we look for other areas that do have potentially higher returns and look for, what is a good value. And in a couple last presentations, I don't have a slide for it right now, but in the past presentations I've showed, I made the point that emerging markets are significantly undervalued compared to the S&P 500 over time. And so here's just looking at from a price return standpoint, the 10 years, basically kind of the last 10 years, 2011 to 2020, the S&P 500 has significantly outperformed, up 388% versus emerging markets doing 95%. And so in that case, we'd be like, well, why would you even hold emerging markets if the S&P 500 does so much better? And a lot of people make the case, just hold the S&P 500. But look at the prior 10 years. So 2001 to 2011. Emerging markets did 355%, and the S&P did 32%. So that doesn't necessarily mean that the next 10 years is going to reverse and emerging markets are going to do significantly better, but there is that chance, and the probabilities are higher over the next 10 years that emerging markets will most likely outperform the S&P 500. And so we've been increasing to our investments in emerging markets and decreasing slightly US stocks, but we do that incrementally. We don't make big adjustments. We kind of slowly go in that direction over time. Timing those moves can be very difficult, and it may take longer to play out than you think. So this chart is looking at seasonality, and seasonality really from a short-term perspective. In our last market update, the market had pulled back about 5%, and we had said, one of the reasons, there was multiple, but one of the reasons that we had gone a little bit defensive prior to that drop is that seasonally, that September through October timeframe, you can see here that seasonally is the weakest 2-month period of the year, down a negative 0.7% on average over the last 120 years. And so that was one reason. You also had some other factors like breadth or bad breadth. And I'm not talking about hygiene here, but we're talking about from the standpoint of market participation. That was weak, meaning the majority of stocks were not going up along with the market. You only had a few stocks kind of driving the market higher. And that was another reason that we had gone a little bit more defensive. And then we left the last market update saying, now we're going to be looking for a time period where maybe the market does dip down lower and we have an opportunity to go from a little bit defensive posture into a little bit more of an opportunistic posture. And so typically what that means is we sell some bonds and buy stocks in that scenario. And so looking here now, as you look at this chart of seasonality, we're kind of going in to the November-December time period through December time period, and that's up 72% of the time. And it also has the largest 2-month return of any of the time periods. So this would typically be the time in the year when we do our rebalances where we would go from more of a defensive posture or a slightly less defensive, going more into a more opportunistic posture. And that's something that we're looking at right now. As the market pulled back, it held up, and we'll see if it continues to hold up. And if that's the case, we'll switch a little bit from, to get a little bit more opportunistic as we go into what's called the Christmas rally. So,
hey, Jason, before you continue, I just want to take a quick technical break. A couple of people have asked if we can make the picture large, and that's a setting on your particular computer or electronic device. You can change the screen views where you can have Jason large, or you can have the charts large, and you can go back and forth. So since a couple of people have asked, I just want to take a quick break to say, go ahead and play around. There's a view button at the top right where you can swap Jason and the shared screen, and hopefully that helps. All right, thank you, Jason.
Yep, thanks, Paul. So now we're looking at commodities, and the commodities is something we've been talking about quite often over the last year, and it's something that you usually bring up in inflationary time periods. And so this particular chart looks at the CRB index, which is your main index that is a broad basket of commodities, versus the S&P 500. And so when this chart goes down like it did in the 90s, that means the S&P 500 did better than commodities. But from 2000 kind of through that 2009 period, when this line went up, that's when commodities did better than the S&P 500. And so now fast forward over the last 10 years, you can see once again the S&P did significantly better than commodities. However, you have a pretty major trend break right here where commodities are starting to outperform, and they have over the last little bit more than a year. They've outperformed the S&P 500. And so this is something that we've been investing in through various methods, whether it be a basket of commodities through a fund, even gold and silver at times. And this is something that we believe should be a part of your portfolio and is a part of our current portfolio as we go forward, unless conditions change and inflation comes down significantly. So this is kind of just looking at the CRB index, not comparing it to the S&P 500. And you can see here another confirmation that the trend has broke right here, both broken out of this resistance line and also this downtrending resistance line. And you can see a very nice uptrend here. So, while things don't always go straight up over time, the long-term trend here has been up for commodities. We think this is a sustainable trend over time. There will be some bumps along the road, especially if inflation comes down some. This will go down. But we believe this is an opportunity, over the next few years that could present some higher returns than maybe the general kind of the S&P 500, something that we're currently invested in. All right, so now switching over to the safer side of the portfolio, the bond side of the portfolio. And this is looking at US 10-year bond yields. And it's important to know that yields trade inversely to bonds. So you can see over the last 10 years, while yields have come down, this chart isn't showing, but it is the reality. bond prices have been going up during that time. And so there's an inverse relationship there. Now, we're coming up to a pretty crucial point where after the pandemic, or during the pandemic, yields dropped to next to nothing. And they went down to about 0.5%, the lowest really in the last 100+ years for the US Treasury yield. Now, it spiked up pretty sharply and got up to about 1.7, 1.75. Right now, we're at 1.65. A break above this 1.75 level right here, kind of this blue line, would indicate that the yield is probably going to go higher, which bond prices would go lower. And so that's important to keep in mind as we try to position our bond portfolio, understanding that this inverse relationship is if bond yields go up, bond prices would go down. And that also plays into, you know, kind of which areas are more susceptible to bond prices going down, whether it be the duration, if it's long-term or short-term, and which type of bond, which I'm going to get into on the next slide. But this is something that goes into kind of looking at what are the probabilities, and it's a busy slide, I'm going to explain it, but what are the probabilities that interest rates, meaning the Fed's fund rates, the Federal Reserve, when they raise rates, what is the probability that they will raise rates by July of next year? Okay, and 1 month ago, there was an 87% probability that rates were not going to change. That was the expectation at that time. And now if we look at it, said in another way, there's only a 13% chance that rates were going to go up. Now looking at it, there's only about the probability of rates staying the same is less than 40%, which means the probability of rates going up is greater than 60% by July of next year. So that's something that's really adjusted recently, and that could potentially mean that interest rates are going to go up sooner than what we were expecting about a month ago even. And part of that is kind of a good thing from the standpoint of usually that happens as the economy rebounds and inflation starts to increase, those kind of two main factors. And so the economy rebounding and starting to overheat is a reason to raise rates. And we're still very early in the interest rate rising cycle. We haven't risen rates one time. We're at almost zero right now. And so, in fact, we're at 0 to 1/4. That's where we currently stand. So, you know, we're not at the point in the cycle where raising interest rates are really going to hurt the economy. That tends to come after a number of interest rate hikes. In fact, the last cycle that happened around 2018, and we got up to 2.5% on the Fed funds rate. So we're a long ways away from that. But it could factor into how we position our bond portfolio. So I could spend an hour on this slide, but I'm not going to bore you guys to death. But this is a very important, and there's a lot of information here. But just so you kind of know what goes into our mind as we're positioning our client's bond portfolio, is that there's a number of different factors of why to own bonds and why to own which type of bonds. In general, bonds provide income, and they also provide stability to your portfolio. And the way we like to own bonds is they tend to be a non-correlated asset, which means bonds would go up as stocks would go down. And so you can see here, this little column right here is the correlation to the S&P 500. So if it's negatively correlated, that means those bond prices tend to go up as the stock market goes down. So one that is a great hedge in falling markets when interest rates are going down and we're going into a recession. Historically, holding the 30-year Treasury bond, long-term Treasuries have been a great position to be in as stocks go down. However, if interest rates start to go up, you can see here, this is the price return of a 30-year Treasury bond, this little gray one, if interest rates go up by 1%. So the longer term the bond, the more susceptible they are to bond price drops if interest rates go up. And you can see on the opposite, short-term bonds, like a 2-year Treasury, don't fluctuate much when interest rates go up. They're not as interest rate sensitive. So while we do like to have non-correlated bonds in our portfolio, especially when markets go down, and we always have to be prepared for that. That's one of the ways that we try to manage risk really well, is owning non-correlated assets. What we have to try to find going forward in a rising interest rate environment is which bonds are still not correlated to the stock market, but also produce a little bit of a yield. The problem with going to a 2-year short-term treasury right now, you only earn 0.4%. So the other kind of what we believe and what we are currently invested in, which will probably end up increasing in this rising interest rate environment, is what's called MBS, mortgage-backed securities. They're also called agency bonds or Fannie Mae or Ginnie Mae bonds. Those are negatively correlated and they have a higher yield. And if interest rates go up, they don't decrease nearly as much as what long-term treasuries do. And so that's one area from the US bond category that we would invest in. You could look at this chart and say, hey, convertibles do pretty well when interest rates go up, which is true, but convertibles they're almost exactly like stocks. A correlation of 1 would be the exact correlation of stocks. So they go up and down with stocks. So they don't provide you that protection when markets go down. Similar to kind of US high yields, or what's called junk bonds. They don't provide that protection when markets go down. And so while we may own, a small portion of those bonds that generally or generate greater returns, we also want to have but we want to make sure we have a core portion of our bond portfolio in a non-correlated bond that protects against falling markets, because that's really a key piece to owning bonds and protecting accounts. So as we kind of look out into the kind of landscape of bonds, we have to get a little bit more creative with interest rates really low and interest rates going up in the US. And so, while we are encouraged by what we see in terms of the potential of emerging market stocks, we're also encouraged in the potential of owning emerging market bonds. And so, we've held other bonds that protect for inflation, like TIPS, Treasury Inflation Protected Securities. But if inflation starts to go down over time, that could potentially hurt TIPS. And so we need to find another area that can also protect for inflation, but at the same time, try to generate a different yield. So in this, we list about some of the top economic countries in the world. We look at their debt to GDP, and then we look at their 10-year bond yields. And you can see the United States from a debt to GDP ratio, and that's a ratio that measures kind of the gross domestic product, what the economy is generating, divided by its debt, or the other way around, debt divided by its GDP. And so a high ratio would indicate that the country has a lot of debt. A lower ratio would mean that it has a lower amount of debt, especially to the amount of its GDP. Okay, so all the green ones here are emerging markets, and you can see the United States here would be red, also Japan, United Kingdom. All of these top ones are kind of your more developed countries. And so the more developed countries have a lot more debt. The emerging markets tend to have less debt right now. And at the same time, you can see, the 10-year yield on the US Treasury is 1.6. Some of these other countries like Japan are like flat. They have no yield. Even Germany's not listed on here, but Germany's negative right now. Germany's down here. So it's negative. But if you look at Brazil at 11%, or in India at 6%, even China is almost twice as much as the US at 3%, Mexico 7.5%, Indonesia at 6.2%, and Russia at 7.5%. You have emerging markets that have lower debt to GDP, which potentially means that they're a kind of a safer country from that one standpoint. There's other issues, but from that one standpoint, they're a little bit safer, and they have higher yields. And typically, even if there was an inflationary environment, they would perform well in that. So the only kind of problem with emerging market bonds is they tend to be very volatile. But this is an area that could produce greater returns without taking some of the risk of the emerging market stocks, less risk than the stocks, but could give you a little bit more extra return potentially in our bond portfolio. And so that's something that we may be transitioning to as we move forward. Now, this has been a question with a lot of our clients with the cryptocurrencies. I'm going to end on the cryptocurrency piece. And some clients have asked if we'll ever own cryptocurrencies. So I want to point out two of the main ones, the largest one, which is the Bitcoin and then Ethereum. We're looking at Bitcoin here, and you can see Bitcoin is in a nice long-term uptrend. The kind of big issue, and I'll point this out on another slide, it's a very speculative security, okay? And you really can't, in a typical brokerage account, you can't own Bitcoin or Ethereum. You have to buy it through an ETF. So this is looking at the ETF for Bitcoin. And you can see here, it dropped over 50%, nearly 60% from around February, March of this year into July. That's a major drop. And that's very difficult. It's a very volatile security, and it can cause a lot of losses. Now, it has rebounded strongly from there, and we're kind of approaching this long-term resistance. So that's something that we're watching closely. But the other factor too is they're not non-correlated. They're non-correlated a lot of times to the dollar, but not non-correlated to the stock market. So in March of last year, when stocks took a big dip, the S&P was down 35%. Bitcoin went down almost 60%. And so it's a difficult security to own as a protection for your other stocks. It's not non-correlated. It does have potential to add alpha or add additional returns, but you have to be willing to take a significant amount of risk. And so this is similar looking at Ethereum. It took a major drop around the same time Bitcoin did. This ETF that tracks Ethereum fell about almost 70%. And also another big drop here too in March of last year. So it can take significant drops, 75, even 80%. Ethereum is a little bit more volatile, potentially has a little bit, with higher risk, maybe has a little bit potential for higher return, but you have to be willing to, if you're going to hold this, for it to drop 50 to 75%. And that's very difficult to do as we manage risk really well. But from a technical standpoint, we're approaching a major kind of resistance point on Ethereum. So that's something that we'll monitor. If it breaks that, could make it run higher. So something that we're watching. So to sum up cryptocurrencies, our thoughts on it, what we're doing about it, the case against or the case for cryptos, a lot of times people point out Bitcoin is very scarce, and something like gold is scarcity that gives it value. However, I would make the same argument on the case against cryptos, is that they're producing new cryptocurrencies every day, and so there's a lot more supply there. It can be a little bit of a hedge against the dollar. That's a case for. Millennials are adopting it like crazy, and as they inherit money, more and more money is going into cryptocurrencies. It's got momentum on its side, and even like Ethereum, for example, is used for non-fungible tokens, NFTs, which are like digital art, trading cards, things like that, digital videos that are, basically have, they're one of a kind, and so you can buy it, and those are being traded. So you're having new markets completely go digital, and Ethereum, blockchain in general, kind of being the backbone of it all. And there's some increased payment acceptability. The case against, though, I won't go through every single one, but there is some bubble-like characteristics. When you have huge runs like this, and everyone and their mother are talking about it, that's a bubble-like characteristic. So it doesn't mean it can't go higher. Bubbles can get bigger, but it just means that the risk is significantly higher. And then you had China recently ban cryptocurrencies. India's already banned it. Turkey's banned it. Denmark. So a lot of countries have actually banned it. And in the past, in the U.S., from 1932 to around 1970, early 70s, we banned ownership of gold. So there's nothing stopping the United States from banning cryptocurrency. So that's something that you have to watch from a regulatory standpoint. That is a possibility. And the biggest case against it is they're extremely volatile. So a guideline for owning a cryptocurrency in general, or any really speculative type of security, is never to own, and this is even on the highest end, never own more than 5% in your investment portfolio, and only invest what you're willing to lose all of, because there is that chance you could lose all of it. And people have gotten rich investing off of cryptocurrencies, and maybe even GameStop and some of these type of really speculative securities. However, on about a 10, if not 100 to 1 ratio, people have lost money. So you do hear about those stories of people making a lot, but you don't hear about the stories of people losing a lot. And so we would just be very cautious. From AllGen's standpoint about us owning it, it is something that we're open to owning over time, but it would be a very small portion of the portfolio. And we like to try to find it when it pulls back, when people don't like it a lot, and it's undervalued, if you will. and it starts to build a nice base and it starts to break out from it. And it just hasn't presented that opportunity over the last year for us to get into it. But it's something that we may own as a small portion of our more aggressive accounts. Just hasn't presented the opportunity yet. So I'll end on that.